Good morning, ladies and gentlemen, and welcome to the AEW UK REIT PLC investor presentation. For your information, throughout this presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time via the Q&A tab situated on the right-hand corner of your screen. Simply type in your question and press send for management to review. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where appropriate to do so. These will be available via Investor Meet Company dashboard. Before we begin, I'd like to submit the following poll. Finally, I'd like to remind you that the presentation is being recorded. I'd now like to hand you over to Laura Elkin and Alex Short, Portfolio Managers at AEW UK REIT PLC, and Richard Tanner, Managing Director of AEW. Thank you.
Good afternoon. I'm Richard Tanner, Managing Director of AEW UK Investment Management. We are today talking about the AEW UK REIT, which we launched some 5 years ago now. Shortly, I'll hand over to Alex Short and Laura Elkin to discuss the REIT in more detail. But ahead of that, I thought I'd give you a bit of an overview of AEW UK business, a quick market overview. So starting with AEW UK Investment Management, this is the investment manager of this REIT. The business was formed about 9 years ago as a 50-50 joint venture with AEW Europe. The alliance between the businesses allows UK to have ultimate control over its investment decision-making process, but still having the resources of one of the world's largest investment managers. Many of the senior business members of AEW UK worked together at UBS for 15 years or so, and have records going back together over 20 years. In addition, many of our staff members personally, like myself, invest in the funds we run, including this REIT. Moving on to the current market conditions, the AEW UK response to COVID-19 from a business continuity perspective has gone quite well, really. It meant that our staff and suppliers were fully functioning during the lockdown period, and we've now, as the three of us are in the office today, have started tentatively returning to the office as staff are able and comfortable to do so. In the commercial property market, we saw a significant slowdown on the outbreak of COVID-19 in the UK. However, since the easing of lockdown, we've seen activity levels start to emerge and renew across the market. One of the positive catalysts for this was the RICS giving guidance that physical property inspections could start again. We now expect this to allow a more normal functioning market, and as we gradually see the removal of the material uncertainty clauses moving through various sections of the market, starting with industrial. This is a key section for the company, because the largest weighting we hold is in industrial assets. In terms of longer term impacts, we would certainly hope to see some improvement in our own share price as lockdown eases. And indeed, I think we're seeing the lockdown recovery in the share price mirroring what we're seeing in the direct market. In terms of the real estate markets themselves, it seems very likely that internet retailing will have moved to a much higher market share longer term. We see further physical weakening of retail rents and boosting of warehouse demand in the UK. The AEW UK portfolio is very well placed to benefit from this. In terms of sectors, it's still unclear what longer term effects of home working may be, but it seems unlikely that sectors like the out-of-town office market will be immune from the home working changes from COVID-19. For this reason, we see lots of sense in backing strategies such as this, which place high consideration to alternate use values in their investment process. The subject of today's conversation, of course, is AEW UK REIT, so I'll hand over to Portfolio Manager Alex Short and Laura Elkin to provide more details.
Thanks, Richard. Hi, I'm Alex Short. I'm the Portfolio Manager for the AEW UK REIT. And as Richard said, I'm also joined by Laura Elkin, who jointly manages the portfolio. The purpose of this presentation today is to provide a bit more colour on some of the recent news stories that the company has released. It's been a fairly active period for us, and we thought having a bit more information available might be interesting. So firstly, a quick reminder of the strategy of AEWU. We are a diversified high-income REIT, and we've consistently paid a dividend of 8p per share per annum since the completion of our initial investment back in early 2016. So a very stable track record of paying that dividend. The strategy means that we invest in core UK commercial property with a focus on buying assets in strong commercial locations, generally looking for areas that have low levels of supply and high levels of tenant demand. This is helpful for us maximising performance of our assets, of course, and keeping our occupational levels high. We have consistently had occupation levels in excess of 96% across the portfolio, so very low levels of vacancy for the previous consecutive 7 or 8 quarters. In terms of the assets that we favour, we've tended to buy assets with shorter to mid-length leases, and that's allowed us to support a high level of income from the portfolio. One area that we think we are particularly good at is stock selection, so identifying the assets and locations that will allow us to support a high income level over the long term and also to make it sustainable. So for each asset, we generally write a business plan prior to purchase, and that is sent across the team, so to the various expertise, investment team, asset management team, and so on. So the plans are clear and agreed from the outset in terms of what we're looking to achieve. From there, we manage our assets very proactively, often looking to lengthen the income stream to unlock capital value. And in a few moments in this presentation, we will talk about a couple of assets where we have recently successfully managed to do that. We look to use diversification as a way of managing risk. So we tend to seek diversification of tenants, so not too much of our income from one particular tenant or tenant type. We diversify by property type and by geography as well. That said, fairly early on in running this REIT, we identified that secondary industrial properties were looking as though they would perform very well on both an income basis and a capital add basis. And we have put the majority of this portfolio now into the industrial sector, and it has performed extremely well and continues to do so. And we've seen very strong rental growth. We have a very low average passing rent on our industrial portfolio of only £3.50 per square foot. So a really good low base from which we can see rental growth. And we've also seen, particularly in recent weeks, that tenant demand for warehousing is actually increasing. So in some sectors, we've seen a slight dampening of tenant demand, but in industrial, the whole COVID pandemic seems to have further increased tenant demand for some of these units. The strong performance from our property assets is probably best demonstrated by our property level returns, and we have outperformed the MSCI Balanced Fund's quarterly index on an annualised basis over the past year and on an annualised basis over the past 3 years. The portfolio also produces the highest level of income of any fund in the index, so it's a track record we're fairly proud of. Moving on to touch on some of our recently announced results from our annual report for the year ending March. We're generally very pleased with the performance of the portfolio, particularly given a fairly turbulent economic political backdrop that we saw during this period with Brexit and then, of course, fairly rapidly moving into the pandemic. Most encouragingly was any underperformance from the NAV was felt predominantly as a result of market sentiment and valuer yield shift rather than actual occupancy issues within the portfolio. And as a reminder of the statistic that I just mentioned earlier, that the portfolio vacancy level has remained very stable and very low. Obviously, seeing this at such a time is a reminder that these are really resilient assets that we hold, and we think we have chosen a very defensive portfolio that we expect to continue to perform well going forward. A major highlight of the year was the growth seen in the company's earnings, which stood well in excess of our 8p target at 108% covered. The type of performance that we expect to see from our assets over the long run is demonstrated by two of our very recent asset management successes, which are both expected to be materially NAV accretive at our next update, which will be in mid-July, so coming up in the fairly short term. I'm going to hand over to Laura, who will talk through these transactions that have completed recently.
Thanks, Alex. So seeing major news headlines that we all have in recent weeks, I expect that there are many out there who would believe that letting transactions have all but ceased at the current time. But based on what we're seeing from within the AEW portfolio, this is definitely not the case. So back in May, we announced the sale of Geddington Road, Corby, the company's largest asset, which returned an IRR of over 30% within the 27 months of our ownership. The sale price crystallised significant value add, being at a level 25% in excess of the valuation prior to the sale, and 52% ahead of the purchase price paid for the asset in January 2018. In addition to this, the asset had produced a net income yield of 10% per annum throughout its hold period. The reason why we were able to achieve such a strong outcome to the sale lies in the asset's optionality, which is a common feature that we look for when acquiring assets for AEWU. To explain how this works in more detail, at purchase, we were aware that the tenant Gefco, who have a short unexpired lease term, were keen to remain in occupation of the asset over the long term, and due to Gefco's covenant strength, the completion of a renewal contract would have created significant value. This for us was business plan A. In addition, though, we also identified that uses adjoining the site, being both newly built logistics and residential, created excess value over the purchase price. Gaining planning consent for either of these uses were business plans B and C, and we pursued all of these during our ownership period. As it happens, though, we were recently approached by the purchaser of the site who wished to occupy it for themselves, and with whom we were able to negotiate very strongly due to the work that we had already done on our existing business plans. So that example isn't alone. From within the rest of the portfolio, we are also currently seeing a healthy pipeline of other letting transactions and lease renewals over which we're having ongoing positive discussions. Some of these are even within the retail sector, although this is a sector to which the company now has very limited exposure at only 12%. Okay, so I will take back over there. The sale of that Corby asset, which has performed so well, obviously leaves the REIT holding a fairly significant cash balance. And we think that's a really advantageous position to be in at the moment. So along with the company's directors, we are currently considering the best uses for the capital over the coming weeks. We're cautiously analysing a few prospective purchase opportunities and seeing some assets that exhibit some really strong fundamental characteristics. So you may see some announcements going forward later in the year on potential purchases. One of the reasons why we expect to see continuing robust performance from our properties over the longer term is at least in part the optionality that Laura has just described. So it's something that we try and build into all of our business plans ahead of purchase, and it helps with our active asset management approach, combined with our ability to purchase short and mid-length income. It means that we can add significant value to some of these assets. Fundamentally, we don't really buy into the story that buying long leases is the safest place to put your money. We actually think that very often shorter leases can provide a better store of value. So by having a shorter lease
and creating an asset management deal to get yourself a new longer lease, of course, you're adding value. Conversely, if you pay a very sharp yield for a long lease and potentially lose that tenant, you obviously lose a lot of value. So this short lease profile combined with an active management approach is one that we particularly like, and it's a strategy that we have run for many years. If you take the disruption with occupational markets at the moment, most notably retail and leisure, longer lease assets in those sectors, of course, have further to fall in value than our shorter lease assets, where we are seeing value add opportunities coming through. We will, in the fairly short term now, in the next couple of weeks, be producing our new NAV, and you will see some of the successes, I think, coming through in those numbers.
So another route for accretion in the NAV that we expect to come through in July is with another positive news story that the company has recently announced, which has been the completion of the renewal lease to the Secretary of State for Communities and Local Government at Sanford House in Solihull. And as a reminder, this is a new 15-year income stream secured against the government department at a level that's 30% higher than previously received. No incentive, capital or otherwise, was given to the tenant, and no refurbishment costs will fall on the company. For us, this deal is really just about stock selection, and gains here have predominantly been due to an identification at the time of purchase that the building was both under-rented and located within a prime market that would likely see growth. Exactly this has happened during our hold period, combined with the tenants that we recognised were very wedded to the location for reasons relating to their occupation for immigration services. Both of these facts allowed our asset managers to negotiate very hard at the time of documenting this renewal, and this has led to an increase in the level of passing rent, 30% ahead of prior income, which at 9% per annum had not been low either. The 15-year term to the government is also expected to be a catalyst for value accretion within the company's upcoming NAV update in mid-July. So moving on from transactions to more managerial matters, another major focus for the company in recent weeks has been working to limit the impact of COVID-19 and the associated wider uncertainty on the company. This is something that really the entire team at AEW UK has worked tirelessly to do. And one area for the focus of this has been in changes to continue to provide a conservative outlook for the company's borrowings. These measures have been taken following advice from AEW's in-house team of property debt specialists, despite the company's overall borrowing levels being low to start with at approximately 25% loan to value, and banking covenants having significant headroom at the last test date back in April. The aim has really been to de-risk as much as absolutely possible the loan exposure for investors in all market conditions. I'll just hand back to Alex now, who will discuss the various steps that we've taken in order to do this.
Okay, so handling our debt on the lowest possible risk basis is something that we have always sought to do. So firstly, a reminder that we have a single term loan from RBS International that is currently drawn to just over £50 million. Just recently, we've announced amendments to effectively convert this facility to provide a revolving credit line with no changes to the existing terms or the margin or any other covenants in the loan. The only changes have been to permit drawdowns up until 6 months before the expiry of the facility, and the company now has the full flexibility over doing this in line with its LTV covenants. I'd also highlight that over the long term, AEWU doesn't have any intention to amend its long-term gearing target, which has always been at around 25%. It's a conservative level of gearing, and that is exactly where we would expect to remain. The new commissions will be used to repay £5 million of the loan in the short term, and that is obviously in order to bring the current gearing level slightly below the target. Another action that we've taken recently has been the documentation of the lender's waiver of all ICR covenants until 2021, which again was permitted with no cost or any additional conditions to the company. The covenant tests were actually passed with significant headroom at their last test date in April, but given the uncertainty across the market at the moment, we just felt this was a fairly prudent decision, and since there was no cost attached to it, we decided to document that. Back in late 2019, RBSI also approved the increase of AEW's hard loan to value covenant, which was pushed from 45 to 55%, and would now permit a 30% fall in values before it could be enforced by the lender. Looking back, obviously we had no foresight of the pandemic that was going to come, but obviously looking back, we feel that that has been a fairly fortuitous amendment, again made at no cost. That said, we have not seen anything approaching those types of value falls in the portfolio, and neither are we expecting to do so, but always good to manage these things on a low risk basis, I feel. What we have been grateful for all of these slight amendments that we've managed to document is the very strong support that we've received from RBSI, and it's been very encouraging that they've been so helpful. They've expressed ongoing support to the company and stating that an extension to the current waiver of ICR documents is likely, but obviously we will review that if we need to at a point in the future. Laura?
So in keeping with this approach of conservatism towards debt, the company also took the decision to acquire an additional interest rate cap at 1% on the entirety of our current drawn loan amount of £51.5 million. Any of you that are familiar with the company will know that it previously held caps at 2%. However, given the current period of low rates, the extension of this cap looked to be cost effective when compared to potential savings that could be made in the future. The company's cost of debt is currently low at 2.1%, and we clearly wish for it to remain this way. Another area of focus for us recently has of course been on rent collection, a very much discussed topic. We have now collected 85% of amounts due to the company for the March quarter, with a further 10% of payments due to be received over long-term payment plans. This leaves us only 6% of rental amounts for the March quarter that are outstanding, and we are actively pursuing tenants for these amounts, both at the current time and in full force once government legislation allows us to do so. In terms of the June quarter though, early indications show that our rental collection so far looks to be broadly similar to that of March, if not marginally ahead, which is very encouraging. What we have noticed is that some tenants who resisted payment during the March quarter have now started to pay off their arrears as restrictions start to be lifted. This leads us to believe that on the whole, most of our tenants do want to continue with the resumption of their normal business practice, and this includes the payment of rent. We recognise the importance of this collection statistic to investors though, so we'll update the market more fully over coming weeks as we move through the quarter. So in terms of providing a summary of recent major news items for the company, this has really mostly been covered, but we continue to look forward, and I will just touch on what we are currently doing in respect of the company's investment pipeline. Richard provided a market overview at the start of this call, and I won't repeat the themes he covered, but will add that we remain very alive to market knowledge in all sectors at the moment and have done so during the lockdown. Our entire property-focused team has been joining numerous calls each week with all major agency houses who are reporting to us on what they are seeing, including both on and off-market availability of investments. As such, we're analysing opportunities for the company and have to date come across some which look interesting. We are analysing these opportunities further at present, but would highlight that we are increasing focus on capital preservation through various uses, as a method of de-risking any positions that we do choose to take. And this has always been a focus for AEW's buying strategy, but it is one that will be even more important over coming months. So thank you for listening today. We know that various questions have been asked. We will turn to those now.
Thank you very much indeed, and apologies to investors. We have had a technical issue with the link. Thank you for those who have dialed in. You will be provided the opportunity to ask questions post the event, and the slide deck will be passed to you also. We have had a number of questions pre-submitted, which I think we can run through. Let's start perhaps with the first one. What's your outlook for the company's dividend in terms of the short and medium term? Perhaps I can address that one to you, Alex.
Yes, I'll pick that one up. So the dividend, we know, is a key feature for our investors in this REIT. As we said, it is the highest in the peer group, so we pay 8p per annum, so 2p per share per quarter. It has been very reliably paid, and it has been almost always covered. There's been the odd quarter of very marginal uncover. Now, for that reason, going forward, we are going to recommend to our directors that we would like to pay the full 2p at the next dividend that will be declared in the next couple of weeks. It is, of course, at the directors' discretion whether to take that advice. But based on the level of March rent collection that Laura's discussed, where we have pretty strong collection rates with only 6% unaccounted for where we're chasing tenants. We obviously, of course, have fairly high cash weighting in this REIT at the moment as well. And because we think that this is a relatively short-term blip and we can pay this dividend with only a very marginal level of uncover for the next dividend to be declared, we will make a strong recommendation to the directors that we would like to pay the full 2p. They have also very reliably made statements in the past that they will always seek to pay the 2p where it is in the best interests of the company and the shareholders, and I suspect that will continue to be the direction that they will take.
Fantastic, that's great. Thank you, Alex. Another pre-submitted question we've had. You mentioned other asset management strategies that you're working on. Are you able to give some colour on these? Perhaps I can address that one to you, please, Laura.
Yes, thank you. As I've mentioned during the dialogue, we do have a number of potentially value accretive asset management discussions ongoing with our tenants. Rather than specifically name any of those parties, though, I'll just give a few examples of the types of transactions that we're looking at in each sector at the moment. So starting with our industrial properties, a number of times in recent weeks, we have agreed terms to extend leases and also increase rents. This is really generally the movement of travel that we are seeing across our industrial portfolio, and we expect this to be able to continue. Some of the discussions that we have going in the retail sector at the moment are also lease renewals and extensions, although in these cases, really without the ability to increase rents. But rents are generally moving in line with our independent valuer estimates. With some retail tenants, we've also gained additional traction in negotiations during the lockdown by, for example, offering them short-term rent-free of, say, 3 to 6 months in exchange for lease extension. In some cases, this has increased terms by only a couple of years, but in others by up to 10 years. So we think that that has been a very positive move. Turning to our office portfolio, really a number of different sort of business plans playing out here at the moment. Clearly, with the example that we've already talked about in Solihull, that has been a very accretive lease renewal on a long term. But in other locations at our assets in Glasgow, where our business plan has changed throughout the hold period to move towards alternative use redevelopment, we're actually in quite advanced negotiations with an occupier to acquire this building from us, albeit the timescales for this transaction are likely to be slow and are expected to take many months. In other office assets, such as our building in Oxford, we are working on long-term plans to improve occupancy, such as with our healthcare tenant Genesis, who have taken 25-year leases on other buildings within the estate and have expressed to us their desire to expand further in the location.
That's great. Thank you very much indeed. Another pre-submitted question that we've got in, what is the situation at Bubbott Hall Industrial Estate in Rotherham? When is Hydro slash Sapia moving out? How is your current full-year revenue projection impacted by that? Again, Laura, perhaps I can address this one to you, please.
Yes, thank you. So I guess quite a specific question there. So I'll give some background first for anyone who's not familiar with the asset. It's an industrial asset that we own in Rotherham with a value of just under 3 million, to put it into context of the wider portfolio. During the last 6 months, the tenant Hydro Components has been in touch with us to state that they won't be renewing their lease when it expires in December 2021, and in fact they may wish to vacate sooner. The tenant has been in occupation of the asset since purchase in 2016, and we have been receiving an income stream of approximately 9% over this period. So I guess firstly, in answer to that question, I would highlight that whenever the tenant does choose to vacate the building, they will still be committed to pay income to us until December 2021, when their contractual term expires. So in answer to the question of how will our full year revenue be impacted, the answer is that for this financial year, it won't be. This vacation of the tenant won't potentially start to impact our income stream until early 2022. That said, we're already very alive to seeking a solution to the vacancy, and together with the tenant, we have jointly appointed a local occupational specialist to begin finding a replacement tenant. Clearly now we're just at the start of this process, with the building having not been vacated yet. But the initial advice from the occupational specialist is that we would expect to achieve a letting without a prolonged period of vacancy at potentially a higher level of rent than we were receiving before. The current passing rent being paid by Hydro is only £3.35 per square foot, and expected rental value here is nearer to £4 per square foot.
That's great. Thank you, Laura. We have had a few questions that have come in, which I don't know if you've had a chance to review there and then. We can always address these post-event also. I don't know if you guys have had a few minutes just to look at those. If not, we'll address those post-event. Perhaps we'll just come back to those post-event. Okay. Laura, could you...
Sorry, they weren't in the Q&A box. So,
yeah, no, sorry, they're just in the presenters column there, so apologies. So we've had a technical issue with a number of people clicking on the link. However, those who have dialed in have submitted these questions, so perhaps if you want to have a quick scan of those ones, if there are ones you would like to answer, please do so. If not, we'll address those post-event.
Sorry, we're just quickly reading those questions now. Just bear with us if you could, please.
Thank you very much indeed.
So we have a question here, which is, do you plan to sell the properties that you've secured long leases on to recycle the funds into short lease opportunities? I mean, the general overview answer would be, on the whole, yes. If we secure a new long lease across an asset, that generally, of course, pushes the yield down and the capital value consequently quite a long way up. And that is exactly what has just happened at that Solihull property that Laura was talking about, where we've just secured a new 15-year lease to the government. In completely normal market conditions, I think it is very likely that asset would now be actively marketed for sale. I am conscious, though, that we have a comparatively high cash weighting at the moment. We have a few assets lined up that we are considering as potential purchases. What I don't want to do is sell another asset and put more cash into the REIT until we're very decided on precisely what we're going to do next with it, because, of course, having too high a cash weighting is not helpful to our ability to pay the dividend. So in principle, yes. In terms of timing at the moment, we perhaps might be 2 or 3 months slightly delayed compared to what we might do in more normal market conditions. There is a further question.
Yeah. So we've had a further question. Can you publish a simple version of your business plan on your website for each property? So on our website, we currently show each property, and we have a few bullet points description of I think a very simplified version of what our business plan or outlook would be for that asset. At least the description. I think what we're quite nervous of doing in some cases is publishing full business plans for assets very publicly, and clearly those can be read by tenants, and those can be read by competing strategies or competing property owners adjoining our assets. I think therefore we would be not willing to very publicly publish full business plans for our assets. For example, in some locations, if tenants are paying low levels of rent, our business plan there would be to remove that tenant from the property, where we are able to secure perhaps a stronger tenant or a tenant willing to pay a higher level of rent. In those cases, clearly that could be detrimental to our business plan. I think what's probably best if investors want to stay better informed about the company's plans is to perhaps continue doing presentations such as this. And clearly this is a new format for us, so we would welcome your feedback.
Okay, I'll jump in now because we have a question here about have we considered selling down our retail assets to give the fund more focus on industrial. Obviously, this is a theme that's played out through my entire working career of sector specialization versus more generalist funds. At the moment, I think the industrial market is riding high. We've been very heavily weighted towards that, and that's done incredibly well. What we see, though, over the longer term is that at some stage we will get a supply response in the warehouse market, which will take the steam out of a market that's being very beneficial at this stage. And indeed, we'll get a mean reversion within the urban town centres, which may well be retail or leisure type assets. So I think we do consider this. We obviously fully aware that if we were fully industrial at this current stage, we'll probably get a much higher rating on our share price. But our weather eyes into the longer term when we might want to move our positioning back into a different direction again.
That's great. Thank you, Richard. Guys, if there are no other questions that you are looking to answer, perhaps Laura, I could hand back to you just to wrap up and conclude, please.
Yeah, thank you. So just in terms of summary today, we'd highlight really what we see as being the robust positioning of all major features of the company. Our debt position, which has always been conservative, has now been significantly more de-risked due to the support of our lender. In terms of the portfolio focus on industrial and warehousing, we expect this to continue to be beneficial to both income and value going forward. We also believe in the ability of the wider portfolio to generate robust performance going forward due to the inbuilt optionality that we have in holding our assets at an average value of only £63 per square foot, and a number of asset management discussions that we currently have ongoing with our tenants. So we'd like to thank you all for joining us today, and we really hope that you have found the call useful.
That's fantastic. Thank you very much. Thank you, Laura. Thank you, Alex, Richard. That concludes today's presentation. Apologies to those who are coming through the link, and thank you very much for those who dialed in. A copy of the presentation will be sent to everybody post the event, and also the opportunity to submit any further questions and provide your feedback. Thank you again for attending today's presentation, and that concludes the event. Many thanks indeed. Thank you all.